Adjunct Professor Moran, Microeconomics 112. In this chapter we're going to be reviewing the demand for resources. We're constantly going to be using the example of labor, but this applies to all factors of production: land, labor, capital, and entrepreneurship. The significance of resource pricing, or the demand for resources, is money income determination, resource allocation, cost minimization, and ethical considerations. Money determination: the higher the demand for a resource, the more money will be paid. So resource prices are a major factor in determining the income of households. The expenditures firms make in acquiring resources flow as wages to labor, rent to natural resources, interest to capital, and profit to entrepreneurs. Now, ethical questions. According to the Economic Policy Institute, CEOs for the largest corporations in the country are around $18 million a year. $17 to $18 million. Now that's 278 times to 1 to the typical worker. Now in 1965, that ratio was 20 to 1. So you can see that the rich are getting richer, and it's important to consider whether this disparity is ethical or not. And that's one of the important uses of the demand for labor. What are the different factors going to be paid, and is it ethical? Payment for resources will also determine resource allocation. Just as product prices allocate finished goods and services to consumers, higher value users, lower value users, some people will be in the market, some people won't be in the market. Resource prices allocate resources among industries and firms. In a dynamic economy where technology and tastes often change, the efficient allocation of resources over time calls for the continuing shifting of resources from one product production to another. Resource pricing is a major factor in producing those shifts, making sure that resources go to the most desired product. Cost minimization. To the firm, resource prices are costs, and to realize maximum profit, the firm must produce the profit maximizing output with the most efficient, least costly combination of resources. At the end of the chapter, we're going to do a problem where there is more than one input going into the production of a product, and we're going to have to try to determine how much of each resource to use. Resource prices play the main role in determining the quantities of land, labor, capital, and entrepreneurial ability, resources, that will be combined in producing each good or service. So we're going to be discussing the marginal productivity theory of resource demand. So we're going to develop the demand for resources, and once we have the demand for resources, we can combine that with the price of the product and the resource and determine the equilibrium quantity that will be demanded. We're going to assume that the firm is selling its good in a purely competitive market, so the price it receives for its goods will be the same. We're going to assume that the firm, and that means the firm is a price taker. We're going to assume that the firm is also buying resources like labor in a perfect competitive market, which means it is the wage taker. It's assuming that these firms are so small that it can sell as much as it wants at the current market price and hire as much labor at the current wage rate. So in many examples that's true, but if you go to Seattle, Washington and try to hire programmers, you'll see that that is not the case, as Microsoft will have an impact on the demand for programmers, such that to hire more they'll have to offer higher wages. Resource demand. A demand for resources derived from the product that it produces. Okay, so the demand for resources is derived from the products they help produce. Resources usually do not directly satisfy customer wants, but do so indirectly through the use in producing the goods and services that are desired. So you want a car, there's going to be a demand for auto workers. No one wants to consume an acre of land, a John Deere tractor, or the labor of the farmer, but households want to consume the food from the farm. Similarly, the product for airplanes generates demand for assemblers and Demand for such services as tax income preparation, haircuts, child labor creates demand for the resources that produce those goods. Marginal revenue product. Okay. The derived nature of the demand for resources, the demand for a resource will be derived from the demand for the product it produces, means that the strength of the demand for any resource will depend on two things. The productivity of the resource itself. The more productive you are, the higher demand will be for that resource to help produce the product, and the market value or price of the good it helps produce. A resource that is highly productive and turning out a highly demanded commodity will be in great demand. On the other hand, a relatively unproductive resource that is capable of producing only a slightly valued product will be in limited demand. And there will be no demand for a resource that is phenomenally efficient at producing something nobody wants to buy. So the payment to a resource will depend on how productive that resource is and the market value of the good it's helping to produce. Productivity. Alright, so now we're going to calculate some numbers we're going to need to determine the demand for a resource. Okay. So here's our quantity of input. Maybe labor, could be an acre of land, could be a machine, or entrepreneurs. This is how much product falls off the assembly line given that number of workers. We're going to calculate marginal product, and marginal product is the change in total product given a unitary change in input. So keep in mind that here in this example we're changing this by 1, but if this was 10, 20, 30, 40, you'd have to take this change in total product and divide it by a change in 10. But since there's only 1, that calculation is masked. Marginal product has to be on a per unit basis. So no workers, no output. 1 worker, 7 output. We've increased output by 7. 2 workers, total product is 13. We've increased by 6. 3 workers, total product is 18. The 3rd worker has resulted in an additional 5 units of output. An additional worker, total product rises to 22. 4 more units of output. 1 more worker, 25 total product, an additional of 3 units. Again, remember that marginal comes from a change in 2 lines. 6 workers, total product is 27, marginal product is 2. 7 workers, total product is 28, marginal product of 1. Notice that marginal product is going down. That's because of the principle of diminishing marginal returns. As you continue to add additional variable inputs to fixed plant capacity, output may go up at a faster rate, but then it'll go up at a slow rate. This is going up, but it's going up at a slow rate, and then it actually may turn negative. There are 3 stages to the principle of diminishing marginal returns, but it's named only after this one, diminishing marginal returns. Total revenue is the price of the product times the number of product. 2 times 14 gives you total revenue of 2 times 7 gives you total revenue of 14. 2 times 13 is 26. 2 times 18 is 36. Once you realize that the price is the same regardless of how many products they're selling, you should be able to recognize that this product is selling in a perfectly competitive market. It has a perfectly elastic demand curve for its product. A relationship between price and quantity demanded. Perfectly competitive. Okay, so what's the marginal revenue here? Okay, well, marginal revenue, again, is change in total revenue divided by the change in we're looking for marginal revenue product here. Right. So we're going to take the price and multiply that by marginal product. So 2 times 7 is 14. So marginal revenue product is price times marginal product. So 2 times 7 is 14, 2 times 6 is 12, 2 times 5 is 10, 2 times 4 is 8, 6. Okay. So now we're going to apply a rule called the marginal revenue product equals marginal resource cost. Okay. marginal product, okay, so that was this column which we calculated. The additional output resulting from each additional unit of resource. Additional output from each additional resource which we calculated. Product price we discussed is constant at $2 in this example. The marginal revenue product is the change in total revenue resulting from each additional unit of resource. So it's change in total revenue divided by the change in resource quantity. But since this was changing by 1, as I said, it's masking the fact that you have to divide this a change in total revenue by the change in unit product. So if this is 1, it looks like all you're doing is subtracting out. But if it's a 10, you'd have to take this change and subtract it by the change here. Okay, the rule for employing resources, how many workers should you hire, is marginal revenue product schedule. Okay. This column and this column is the demand for labor. To explain why, we must first discuss the rules that guide the profit-seeking firm in hiring any resource. To maximize profit, a firm should hire additional workers of a specific resource as long as each successive unit adds more to the firm's total revenue than it adds to its total costs. Okay. And since this firm is selling in a perfectly competitive since this firm is selling marginal resource cost, the firm is hiring at a constant rate of, which we'll get to. Okay, so let's apply our rule. We're not going to be using totals, we're going to be using marginals here, and we want to compare how much a worker costs compared to how much extra revenue that worker generates. How many workers would you hire if the wage rate were $13.95? If you could hire one worker and it cost you $13.95 and he generated a total of $14 in extra revenue, would you hire him? Yeah, you'd be a nickel better off. If the wage rate were $9.95 and the worker contributed an extra $14, would you hire him? Yeah, you're like $4 better off. Would you hire the second worker if it cost you how many workers? Okay, now if you're at $9.95, you're going to hire the first worker because he's contributing $14. You're $5 better off. About the second worker, would you hire him? Well, he's contributing $12, so you're $2 better off. Would you hire the third worker? You're a nickel better off. Would you hire the eighth worker? No. I mean the fourth worker? No, because the fourth worker costs you $9.95, but he's only contributing an extra $8 to revenue. You'd be $1.95 worse off. So you would hire 3 workers if the wage rate were $9.95. How many workers would you hire at $7.95? The first worker, marginal revenue product, is contributing an extra $14. So you're about $6 better off. The second worker is contributing an extra $12. So you're about $4 better off, in addition to the amount you're better off here. This worker, third worker, is contributing an extra $10. You're $2 better off. This worker is contributing an extra nickel, 8 minus $7.95. So you're going to hire 4 workers. But you're not going to hire this worker who's only contributing an extra 6. But you're paying $7.95. Your cost is $7.85 in your marginal revenue product. How much is your total revenue change given a change in a unitary change in input? Marginal revenue product is only 6. Again, these numbers going down because of the principle of diminishing marginal returns. What happens as you add a variable input to a fixed plant capacity? How many would you hire at $6? 14 extra revenue, $6 in cost, yes. $12 extra revenue, $6 in cost, yes. $10 in revenue, $6 in cost, yes. $8 in extra revenue, $6 in cost, yes. $6 in revenue at $5.95, yes, you're going to hire the 5th worker. Let's practice. In the next handout, we'll practice with this again to demonstrate, to reinforce this concept of the decision on how many workers to hire is the marginal revenue product. How much extra revenue does the worker contribute to the marginal resource cost? As long as a worker the next worker is contributing more revenue than the cost or wage rate, the worker will be hired. So these are marginal, not total analysis. And the demand curve for the firm will be the number of resources, the demand curve for the input will be the number of resources and its marginal revenue product. So we're going to practice this again and graph this in the next handout.